Good morning. Glad you could join me for coffee. I want to walk you through a few topics in Chapter 8. This, of course, is our last chapter in the textbook, and this will be our final video. So I've got a few different topics I want to cover with you. Let me get me out of the way. And so you will see on the screen this picture of this relationship between a company that's trying to get money and the capital markets. So we are in the place of a needy corporation. We are the company that needs to get access to money. And the capital market, the market for capital, the market for money, that's all the folks out there, the rich folks and the common folks like you and me that have money, and we put it into the bank, or we pay money to an insurance company, and that insurance company is looking for a place to invest their money so it'll grow and they can answer claims when they come in. Or maybe we're talking about a pension plan and it's got all the money that folks like you and me put into long-term savings, and they're looking for a place to invest it. So anyway, back in Chapter 7, we talked about how we might borrow money at the bank and sign a note to the bank, promissory note. Or we might go through an investment bank and borrow money by issuing bonds straight to the capital markets. And so we talked about that in Chapter 7. In Chapter 8, we're going to talk about going to the market for capital, the capital markets, and getting people to invest with us as stockholders. So they give us money, we give them shares of stock. And what that means is that they have a share of ownership in the company. So you can see I've got that designated like a stock certificate basically says you own me. So we want to talk a little bit about what that represents, that share of stock, and contrast it with what we are indicating when we give out debt, like bonds, like we did in Chapter 7. So remember that when we borrow money, like we did in Chapter 7, and we sign an IOU to the lender, whether it be an IOU, a promissory note, or a bond issue, it's simply an IOU. And that's a contract to pay the money back with interest. And so we are obligating ourselves to pay that money back with interest. In Chapter 8, we're talking about issuing stock. And when you issue stock to somebody, when somebody purchases stock in your company, you're making no guarantees to them. Now, the reason people would invest in your company is there are two things that they could get out of it. They could get a dividend if you make a profit and decide to distribute that profit as to the owners. That would be a dividend. There's no guarantee about that because there's no guarantee you'll make a profit. And even if you do make a profit, it could be that you make the decision to reinvest that profit in the company and grow the company and not pay a dividend. So you're not making any guarantees that you'll ever pay a dividend. Another reason people invest is because they want that stock to go up in value. But again, there's no guarantee about that. That just depends on how well the company is managed and, again, whether or not you make a profit. So there's no guarantees to the stockholder. But what is the stockholder getting? Well, they're getting certain rights that go along with the right of ownership. One is they have a right to have a say in how the company is run, and they do that by voting on who's going to run the company. So every stockholder gets one vote for every share of stock they have. So and what they vote on is the board of directors, who's going to oversee the affairs of the business. So the stockholders elect the board of directors, and the board of directors will hire somebody to run the company. It's kind of like if you think about ACU. Now, ACU, nobody owns ACU. It just exists as a not-for-profit. But the board of directors oversees the affairs of ACU, and they hire the president. So they've hired Schubert to run the university. But in a similar fashion, the board of directors will hire the management to run the affairs of the business. So the shareholders elect the board of directors, and the board of directors hires somebody to run the day-to-day affairs. So if the stockholders don't like how the company is run, they may vote on somebody else to make those decisions, the board of directors. The second right the shareholders have is the right to maintain their ownership percentage if new shares are issued. So in other words, if I have 60% of the company, if new shares are issued, I get first dubs on 60% of those new shares. Now, most people don't care about that because they don't have that big a percentage anyway. But if you do have a percentage of ownership that you want to maintain, then you have the right to maintain that if you choose to. A third right is if dividends are paid. Again, there's no guarantee, but if dividends are paid, then you have a right to participate in those dividends. And then finally, if and when the company goes out of business and they liquidate their assets, first they're going to pay off their liabilities, and then if anything is left over, as a stockholder, you would have the right to participate in those leftovers. So you have as a shareholder, you would have the right to vote, the right to maintain your interest in the company, that's called the preemptive right, the right to participate in dividends if they are paid, and also the right to participate in the leftovers if the company should go out of business. So those are the rights of the stockholders. Now let me mention when the stockholders, or when a company incorporates. Now, corporate law is state law, so different states have different laws regarding their, how they oversee the corporations. But in whatever state you incorporate, as a part of that initial filing, for example, if you incorporated in the state of Texas, you could go to the website for the state of Texas, download the forms, fill them in, send them in with whatever it is, $500 or whatever it is, and you are a corporation. So you have established in the eyes of the law this new person, this corporation. And the ownership of that new person would go to the stockholders, whoever invest, and in those articles of incorporation, you would designate how many shares of stock you're going to be authorized to issue. And that's just kind of an arbitrary number, and if you ran out, you could always amend it. But anyway, it's just a starting point. So let's assume we had authorized 200,000 shares of stock to be issued. Now, so far, that's just authorized. Nobody has purchased any of it. We, the company, have not issued any. When we actually sell the stock, issue the stock to stockholders, they give us money, we give them stock. That's called issued shares. And at some point in the future, if we ever decided as a company to buy some of those shares of stock back, we call that treasury stock. And so the number of shares that have been issued, minus the stock that's been repurchased, the treasury stock, that's how many shares are still out there. So, as an example, if we had 200,000 shares authorized, and so far we've issued 150,000, we would still have 50,000 that have been unissued. But anyway, if we've issued 150,000 and we've repurchased 20,000 into Treasury, that means there's 130,000 shares still out there, outstanding shares in the hands of stockholders. So just some terminology there that we may refer to later. So I want you to keep in mind the pros and cons of issuing debt versus issuing equity. So remember, if we issue debt, meaning we borrow money, the nice thing about that is we are not sharing the ownership with anybody. We don't have to listen to those other people telling us how to run things. And the interest that we pay on that debt, remember, interest is an expense. It lowers income, and therefore it lowers your income taxes. The downside of issuing debt is we are signing a contract to pay the money back. And so we have this obligation hanging over us. We have to pay the money back. We have to pay interest on top of that. On the other hand, if we issue stock, the nice thing is we're not tying ourselves to any fixed repayment schedule. The money never has to be paid back. We never have to pay dividends. So again, we're not making any guarantees to the stockholders. However, they own the business, and if we don't keep them happy, they will vote on somebody else to run the business. In fact, if like a founder, if somebody started a business and incorporated, chances are they own most, if not all, the stock themselves, and so they are both the stockholder and the management. But as the company grows, if they get other people to manage it, they still own control because of that stock ownership. So the downside of issuing stock is it spreads the ownership out over more people. More people have a say in how that business is run. If you think about it, like if you ever watch Shark Tank, the thing that those entrepreneurs hang on to is that equity percentage, because they don't want to share that ownership with others any more than they have to. And another thing is when we pay dividends, dividends, remember, is a distribution of profit. It's not an expense. It doesn't lower profit. It just lowers how much of the profit we're keeping. So those dividends are not tax deductible to the corporation. So it's important to understand when you're trying to decide whether or not to, as you're trying to grow your company, and you need money to help you grow, do you want to borrow that money, or do you want to share the ownership of the company? And again, those are pros and cons of each of those. One thing I want you to understand too is once we get this money, how does it impact us later in terms of our income? And so we're going to look at an example of this, and the key thing has to do with this interest on debt being tax deductible. So remember that interest on debt is an expense. So let's look at a situation here where we are raising money, and let's look at the impact of this on our income statement. So we have a company, what's called the Growing Corporation, and it has an initial balance sheet of $200,000 in assets and $200,000 of common stock. So all the money that we have invested in our assets so far has come from issuing stock. And let's suppose that currently there are 5,000 shares issued and outstanding. Okay. Now the company intends to raise an additional capital balance of $300,000. So we've already got $200,000, and we want to get another $300,000, and we're trying to decide if we want to borrow the money by issuing bonds or issue additional shares of common stock. If we issue the bonds, they'll be issued at par with an interest rate of 8%. And if we issue stock, then the stock will sell at $50 a share. And the company will implement the plan, whatever the financing plan, on January the 1st of 20X1. And we want to think about, well, how will this choice impact our income statement for the coming year? So we're just making plans for the future, and we're trying to evaluate Plan A, which is the debt financing, versus Plan B, which is the equity financing. And one thing that seems to give students trouble is that sometimes I think we get mixed up on what we're talking about. Under Plan A, we're talking about borrowing money. So on January the 1st, if we go with that, we're going to debit cash and credit bonds payable for $300,000. So remember, this is a borrowing transaction. Under Plan B, we're talking about issuing stock. So we're still going to get $300,000, that'd be the debit to cash, and we're going to credit the stock account for that $300,000. Now in the chapter I talk about the par value and the additional paid-in capital, and you can look at that discussion. I'm not going to test over that, and so I'm not going to get into that in this video right now, but you can look into that that distinction there. Par value basically represents the face value of the stock. If you sell it for more than par, you use this other account, additional paid-in capital. In any event, Plan A is borrowing money. Plan B is issuing stock. Now in the coming year, these are projections. We think that sales will be $250,000. Our expenses are $80,000 fixed plus 40% of sales, and our tax rate is 30%. So under either plan, our sales we're expecting to be $250,000. Variable expenses, 40% of that'd be $100,000, and then fixed expenses of $80,000. So our EBIT on this income statement, these items in the blue are subtotals. So the earnings before interest and taxes under either plan is $70,000. That's called EBIT, which is a real common acronym. Earnings before interest and taxes. You might think of it as your operating income before interest and taxes. If we borrow the money under Plan A, we're going to pay interest of 8% on that $300,000, which is $24,000. If we issue the stock, there is no interest expense. Now we may or may not pay dividends, but even if we did, they are not an expense, and so they never impact us on the income statement. That brings us to another subtotal, which is earnings before taxes, or profit before taxes. Then we would multiply that by our tax rate, which is 30%. So under the Plan A, our taxes would be $13,800. Under Plan B, our taxes would be more because we don't have that interest. That interest is tax deductible, saving us taxes here. So our net income, or earnings after tax, is $32,200 under the debt plan, $49,000 under the equity plan. Now let me make a point here. Even though the interest was costing us $24,000, since it saved us some taxes, the interest didn't actually end up costing us as much as we had thought, since it saved us taxes. So the after-tax cost of interest is less than that $24,000 that we talked about. So that's an important consideration as well. Or another way to look at that is if you just stop right here, the equity plan looks better because we have more income. But let's think about this from the stockholder's perspective. Remember, the stockholder is the owner of the company. And suppose you just own one share of stock. What kind of impact did this decision have on that share of stock? Well, a commonly quoted number in the financial markets is earnings per share. That's where you take your net income, your earnings, divided by the number of shares that are outstanding, number of shares out there in the hands of stockholders, and that's your EPS, earnings per share. So remember, at the beginning of the problem, we had 5,000 shares of common stock outstanding. So under the debt plan, our net income of $32,200 divided by those 5,000 outstanding shares gives us an earnings per share of $6.44. Under the equity plan, we had more income, $49,000, but remember, we had to issue additional shares of stock in order to raise that money. And at $50 a share, we issued 6,000 shares to get the 300,000 that we were after. So we now have 11,000 shares outstanding. The 5,000 we had originally plus 6,000 new shares. So our earnings per share has come down. 49 divided by 11,000 shares is $4.46. So we would say that the equity plan diluted or watered down the earnings per share. So again, that's the downside of the equity financing, is diluting that earnings per share. Okay, so which plan is better, borrowing money or issuing stock? Well, it depends on your circumstances. It depends on your expectations about the future. It also depends on the amount of risk you're willing to take on. So remember that issuing debt, you have to pay that money back. And even if things get tight, you still have to pay that money back. So if you want to think of it as a personal application, let's say you're going to buy a new car or buy a house, and should you borrow the money or should you just take money out of savings? Well, for one thing, if you don't have the money in savings, you can't do that. But should you go ahead and borrow the money and buy the new car or buy the new house? Well, it depends on what you can afford and also how secure your job is. If you lose your job, you still have to pay that car note, or you still have to make that mortgage payment. So again, there's all kinds of pros and cons about borrowing money versus issuing stock, and you want to weigh all those factors as you're making that decision. One other way to think about it might be, we talked about student debt, and do you want to borrow money for school, or do you want to get a job and pay for it, with the job to the extent you can? And either one of those requires some sort of a sacrifice. You have to sacrifice some time now to work, or the more money you borrow, the more future sacrifice is involved because of having to pay that money back. So again, debt is a serious thing to weigh in terms of the consequences, and something you want to think about seriously. Okay, if we issue debt, we have to pay interest. if we issue stock, we may or may not decide to pay dividends. So I want to talk a little bit about dividends before we wrap this up. In the past, when we've paid dividends, we just debited dividends and credited cash. Actually, those two kind of happen at different points in time. There are 3 different dates that are significant to keep in mind. Let's look at an example here. On November the 28th, the Board of Directors for Acme Corporation declared a $50,000 dividend to stockholders of record on December 20th, 20X7, and the dividend will be distributed on January 15, 20X8. So we have 3 different dates here. The first one is called the date of declaration, November the 28th. This is the day when the company makes a public declaration or a public announcement that they're going to pay a dividend. Now, a significant thing happens on that day. That dividend, that $50,000, becomes a legally enforceable liability. Remember, when we issue stock, we make no guarantees about ever paying a dividend. But on the date of declaration, we lose that flexibility because we have announced that we're going to pay a dividend, and stockholders are out there buying and selling stock based on that information. So we can't change our mind. That becomes a legally enforceable liability. So on that day, we would record it as a liability. Debit dividends and credit dividends payable. Now if you notice, here's my accounting equation, and essentially that dividend reduces retained earnings and it moves that amount over here to the liability section. So we have to carry through and pay that dividend. The next date is called the date of record, and that's just the day when all the names and addresses are gathered together as to who's going to get the dividend. So if you purchase the stock between the date of declaration and the date of record, that means that you are going to own the stock on the date of record, so you'll be getting the dividend. If you purchase the stock after the date of record, that means you are purchasing it ex-dividend, without the dividend. So after the date of record, the stock is selling ex-dividend, and in fact the ex-dividend date is the date when the dividend is no longer attached, and kind of think of it as the date of record, but in practice that ex-dividend date is actually usually a day or 2 before the date of record, just to kind of give the system time to take that into account. Finally, on the date of payment, the dividend checks are actually sent out to the stockholders of record, and we would credit cash and debit the dividends payable. So 3 dates that are important with regard to dividends. And let me just kind of look a brief summary of this. This final screen summarizes what I've just now said, and let me just mention kind of in by way of example here. So let's say Acme Corporation declared a $50,000 dividend, and go back to those that example I mentioned back at the very beginning of this video. Suppose we had 200,000 shares authorized, 150,000 shares had been issued, but 20,000 had been repurchased as treasury stock. That means there's still 130,000 shares outstanding. So if we declare a $50,000 dividend, you're only going to pay a dividend to the shares that are still out there, the outstanding shares. So if we divided that out, that gives us a little over 38 cents per share would be the dividend. And so if you owned 10,000 shares, then multiply that by that 38 cents a share, and this is how much you would get as a dividend check based on the shares that you own. So that's it for Chapter 8. So what I would do is do some of the homework regarding this and take the quizzes. And I think it wouldn't hurt, maybe after doing some homework, is to go back and watch this video one more time, perhaps read the pages that I gave in the textbook in order to confirm your understanding of this. See you later.